Yeah. So class, good evening. So we'll now start our discussion with business combinations. And as the topic suggests, class, we would be dealing with businesses that enter into combinations. Unlike in the past, the board exam does not deal with theory questions for advanced financial accounting and reporting, but at present, the board exam asks theory question already for your advanced financial accounting and reporting. So on my part, I actually prefer the old setup because I do not have to focus so much on the theories. But since the current setup of the board exam includes theory questions for topics covered by advanced financial accounting and reporting, then we will also have to give enough focus and attention to theory portions of the topics. And as I've told you before, the standards that will govern business combination would be PFRS 3 and PFRS 10. And I have given you an assignment previously, class, that is supposed to force you to go over the provisions of PFRS 3. Since our topic is business combination, so it's important to understand what constitute business combinations then. And as you should have read in PFRS 3 class, a merger or a consolidation or an acquisition by an acquirer of an acquiree will combination only if the acquirer represents a business as defined in the standard. I'll elaborate on how a business is defined in PFRS 3 next time. Our focus for tonight would be on the accounting, the actual application of the provisions of PFRS 3 in preparing the financial statements immediately after the combination. And again, understanding what's happening here should not be very difficult because essentially these are just businesses that are combining. And there are two common or major forms of business combination, class. We have your asset acquisition and your stock acquisition. And even the types or the forms of business combination shouldn't be difficult to understand, class, because their names are very suggestive of how they occur or how they happen. For asset acquisition, basically, the acquirer acquires the assets of the acquiree. Before proceeding, it's also important for you to know that the parties involved in a business combination are referred to as your acquirer and acquiree. You may have also heard in the past the terms parent and subsidiary. To some extent, the parent class is equivalent to an acquirer, while the subsidiary is equivalent to your acquiree. But that is only true if the type of business combination takes the form of stock acquisition. Okay, before going more in the details on the differences between an asset acquisition and a stock acquisition, class, again, I'd just like to emphasize that the parties here are referred to as your acquirer and acquiree. We use the term acquirer and acquiree for both asset acquisition and stock acquisition. Now, going back to asset acquisition, class, again, in an asset acquisition, the acquirer basically acquires the assets of the acquiree. Whereas in a stock acquisition, class, the acquirer acquires the shares or the stocks of the acquiree, thereby making the acquirer, class, a shareholder of the acquiree. The acquirer does not intervene, does not disrupt, does not kill, does not terminate, does not dissolve the acquiree. It merely acquires an ownership interest in the acquiree. In a stock acquisition, the form of combination here is just by becoming an owner or a shareholder of the acquiree. But basically, class, if you own the shares of the acquiree, that also makes you the owner of the properties of the acquiree. As you may have learned in your corporation law class, the shareholders have a right over the corporate assets, although that right is only subordinate or inexistent yet, pending the dissolution of the corporation. But essentially, if you're the owner of the corporation class, then by extension, you're also the owner of the properties of the corporation. Okay, so as to the control over the assets class, the acquirer gains control over the assets or the operations of the acquiree in both asset acquisition and stock acquisition. So where then does the primary difference between asset acquisition and stock acquisition lie? Primarily, class, the main difference between the two is as to the result of the, or as to the effect of the combination on the acquiree class. In an asset acquisition class, the two entities, the two parties in the business combination will form into one. At least one would be terminated class. At least one of them will cease to exist. Out of the two previously existing entities class, only one will remain. Okay, there are again there are two forms of business combination: asset acquisition and stock acquisition. Further, class, there are also two forms or two types of asset acquisition. A business combination done through asset acquisition may be a merger or a consolidation class. And the primary distinction for a merger and consolidation class is as to the surviving entity. If it's a merger class, then the surviving entity class will be either the acquirer or acquiree. So even though it's the acquirer class that purchases the assets of the acquiree, it may be agreed upon the parties that the entity that will continue to exist after the combination will be the acquiree. If they've decided that it's beneficial for their business to assume the identity of the acquiree, then the surviving entity may be the acquiree. But who will now have control over the acquiree? Then definitely it will be the parties that represented the acquirer. Okay, but going back to my point, class. In a merger class, the two entities or the parties to the business combination will be reduced into one. And the resulting or the surviving entity could either be the acquirer or acquiree. In a merger, the surviving entity will be one of the previously existing entities. Now, comparing that to a consolidation class, in a consolidation, of course, the two entities would be reduced also into one. But the difference, class, is that the surviving entity in a consolidation, would be neither the acquirer nor the acquiree. Again, going back in a merger, the surviving entity may either be the acquirer or the acquiree. But in a consolidation, the surviving entity will not be the acquirer, nor will it be the acquiree. A third entity will exist as a result of the consolidation of the acquirer and acquiree. Again, two previously existing entities would be reduced into one, and the surviving entity could either be the acquirer or the acquiree. In a consolidation, the parties, the two parties would again be reduced into one, but the one entity that will survive as a result of the combination will neither be the acquirer or the acquiree. A third entity will arise. A third entity will now start to exist, representing both the acquirer and the acquiree. Okay, so for both merger and consolidation, the two for both merger and consolidation, at least one of the parties involved will be terminated or dissolved class. I say at least one. Okay, it's possible that both the acquirer and acquiree will be dissolved or liquidated because a third entity is created for the combined entity this time. Okay, so again, in an asset acquisition, of course, there will be at least two parties, but after the combination, there will now only be one. Bringing now the stock acquisition into the picture class, a stock acquisition is different from an asset acquisition, is different from a merger and consolidation achieved by asset acquisition in the sense that in a stock acquisition class, the acquirer and the acquiree, the parent and the subsidiary will both continue to exist. So please take note of the primary difference. In an asset acquisition, there will be termination or dissolution of one of the entities class. It could even happen that both of the combining entities would be dissolved because a third one will be created as a result of the combination. But in a stock acquisition class, the parent, the acquirer, will remain existing after the combination. And the same is true also for your acquiree, which is your subsidiary. The subsidiary would also continue to exist even after the combination. Because really the main consequence of a stock acquisition class is just a change in the ownership composition. Of course, there are existing shareholders for the acquiree class, okay? But if the acquirer class achieves enough ownership interest in the acquiree to the point that it will now possess control over the acquiree or the subsidiary, then that makes the acquisition of the shares of the acquiree into a business combination. The operations will resume, the operations will not be disturbed. The effect of the combination would really be on the composition of the shareholdings or the ownership interest over the subsidiary. Because if I'm speaking too fast, then it would be a benefit on your part since you can just play again the video class. Now, would the concepts I have just discussed be a primary issue in the examinations class that we will have? The answer is no. Could concepts? Yes, but as to the probability that it would be the concept that will be asked, the probability is very low. Okay, and if it indeed comes out class, then it would be very limited to maybe one or two questions class. Okay, but we're discussing this to at least have a uh, background or foundation as to what's going on in a business combination. So at this point, it's important for you to know the difference between an asset acquisition and a stock acquisition. Just learning class, if they are asked to explain asset acquisition and stock acquisition, they would tend to get confused class with the consideration used in the combination. So again, business combination, an acquirer acquires the acquiree. Is the acquirer Does the acquirer acquire the acquiree for free? The answer is no. Will the acquirer have to pay? Definitely. Okay. So the question now is, will the consideration that will be paid by the acquirer always be in the form of cash? The answer is no. As you should have already encountered in your basic accounting class, in your financial accounting and reporting, the acquisition of an asset class, the acquisition of a business, may be paid not just by cash but also in another form of payments or consideration. How else could a company acquire another asset or business class aside from paying cash? Can it provide can it exchange its non-cash assets? Can it exchange its property to acquire another property? The answer is yes. Definitely an exchange transaction is allowed. An acquirer may give up a non-cash asset to acquire the assets of the acquiree. Now, have you ever encountered a transaction in which the buyer issues or distributes its shares to the seller in exchange of the property that was being acquired? The answer is yes. You should have encountered that when you discuss share-based payments. It's possible for you to make payments. It's possible for you to make purchases, to make acquisitions, but instead of paying cash, you will be issuing your shares. Instead of paying cash, you will make the seller a shareholder in your business or in your company. The same is true, class, in a business combination. Okay, the acquirer acquires the assets or the shares of the acquiree by issuing shares. Okay, can the acquirer pay in cash? Definitely, that's the preferred mode of payment. Can the acquirer, in acquiring the assets or the shares of the acquiree, pay by giving up its property, its non-cash asset? The answer is yes. Can the acquirer again acquire the acquiree, the assets or the shares of the acquiree by issuing its own shares? The answer is also yes. So this is where what I want to remind students. When we say asset acquisition or stock acquisition, we are not talking about the type of consideration. We are talking about what is being acquired. In an asset acquisition, what is being acquired by the acquirer is the assets, the identifiable assets of the acquiree. In a stock acquisition, what is acquired by the acquirer is not the assets per se, but instead the ownership interest or the shares representing ownership over the acquiree. Now, to merge the concepts I have mentioned earlier, class, the type of acquisition and the type of consideration. Is it possible for the acquirer to acquire the assets of the acquiree by paying cash? The answer is yes. Is it possible for the acquirer to acquire the identifiable assets of the acquiree by issuing its own shares? The answer is also yes. Next, is it possible for the acquirer to acquire the shares? Take note of the difference. In the previous two instances, what was acquired were the identifiable assets. This time, the acquirer acquired the shares of the acquiree. And what did the acquirer use to pay for the shares of the acquiree, class? The acquirer paid cash. Is that allowed? The answer is yes. Last scenario. The acquirer acquired the shares of the acquiree by giving or by issuing its shares in return. So the acquirer gets the shares of the acquiree, and in return, the acquirer gives his shares also to the acquiree. Basically, they exchange shares, class. Is that also allowed? The answer is yes. So what is the point? The point is an asset acquisition may be paid in cash or in shares. A stock acquisition may be paid in cash or in shares. So the type of acquisition, class, is entirely separate from that type of consideration that is involved. So I hope that's clear. Please do not be confused nga if we're talking about asset acquisition, that the payment should be in the form of cash or some other asset. Nga if it's stock acquisition, that the payment or that the consideration is in the form of shares. That's not what asset acquisition and stock acquisition represent. Again, the type of acquisition, class, represents the object of the combination. Was it the Did the acquirer acquire the assets? If so, it is an asset acquisition. If the acquirer acquired the shares of the acquiree, then that is a stock acquisition. And for both types of acquisition class, consideration may be in the form of cash, maybe in the form of non-cash assets, property, maybe in the form of shares, or it could even be in the form of bonds or other forms of indebtedness class. Okay, so elaborating now, class, on what will happen on an asset acquisition class. For example, the consideration. Asset acquisition and the consideration is in the form of cash. What happens? The assets of the acquiree will now be transferred to the acquirer. Assets previously owned by the acquiree will now be owned by the acquirer. And in return, what will the acquirer do? The acquirer will pay cash to the acquiree. Now, since the acquiree is a corporation class, okay, in our example, since it's a corporation, all of its assets class are now with the acquirer. The only asset that will remain, with the acquiree class is the cash that was given to it by the acquirer to pay for the rest of the assets of the acquiree. Okay? So the acquiree gave up all of its assets class, and in return it was given cash. Now what will now the acquirer do? I think all the liabilities were also assumed by the acquirer class. So what is now the current status of the acquiree? The acquiree now will not have any liability because, again, in our example, it was assumed by the acquirer. So all that is left, with the acquiree class is the cash that was given to it by the acquirer. What will the acquirer do now? It will now start the dissolution process, and it's a big advantage, class, does not have to because it does not have to bother itself with the realization of its assets because all of its assets were already sold. The remaining asset in the acquiree is just cash. So the acquiree corporation will just distribute the cash to its old shareholders. And once the capital of the shareholders are returned, class, then the acquiree now is dissolved, and terminated. Just for